The question mark in a few reports that all of us have read, and maybe you've read too over the weekend, which is that if indeed this debt reduction level is not going ahead as planned, does it impact the capex plans that Tata Steel has in any way? Also, because while the domestic business is looking so robust, will the cash flows from the domestic business have to now go out and support Tata Steel Europe's operations in a slightly larger way than what would have been the case if this particular event had not happened?
As I mentioned in the very beginning, that the near-term focus is very clearly that Europe does not require any cash support. It should be self-sufficient as far as cash flows is concerned to cover its capex and external interest. So if you really look at it, let me work the other way out. At about, say, 350 million pounds of capex, which it incurred last year, and about 100 million pounds of external interest, it's a 450 million cash neutral position. And that's been achieved almost all years. In some years they have fallen behind, but there are times when it achieves 500 million pounds also. So I think we would stick to the focus that Europe should be self-sufficient in meeting all its obligations and its cash flow needs, and India would have the ability to then invest and deleverage, invest in growth capex, which is announced. Our portfolio for the current moment is pretty clear. We would be about, say, 24 million tons in 2 years' time once the Kalinganagar gets implemented. And therefore we should be in good position from the cash flow perspective, because that's a very competitive business with world-class assets. So I think from an overall perspective, we will drive deleveraging as a target to improve and create more appetite in the balance sheet, and that's what we should focus. As I mentioned to you, at 30,000 crores of EBITDA, 90,000 crores debt is about 3x. We would certainly want it to be lower, but we should do the implementation of the committed growth that we have in India. And between the synergies with erstwhile Bhushan Steel, Usha Martin, our own current business of, say, 18 million tons when implemented in Kalinganagar and Jamshedpur, we would have a formidable cash flow levels, which will then take the deleveraging process further forward.